Everybody wants to be a day trader. The fantasy is magnetic. Wake up, pour some coffee, sit down in front of a screen, and in a few hours, you've made more money than most people make in a week. No boss, no commute, no clocking in or out, just freedom. You're calling the shots, you're in control, and every trade feels like a shot at something bigger. And on the surface, it looks possible. You scroll through social media and see people posting screenshots of five-figure wins. You watch YouTubers clicking buy and sell like it's a video game. You hear stories of traders who started with a small account and within months are supposedly living the dream. It's intoxicating. But here's the part nobody wants to say out loud. Day trading is also one of the fastest ways to blow up an account. Not over years, not over months, sometimes in a single morning, the market has a way of exposing weaknesses quickly. Overtrading, revenge trading, oversizing, ignoring stops, they don't take long to show their consequences. That's why you'll see so many traders who come in excited, guns blazing, and within weeks they're either back to zero or funding yet another account. The truth is, most people don't lose because the market is unfair. They lose because they don't respect what the game really is. This is the PsyFi Trading Channel, where we uncover the hidden side of markets and the mind. Today we're tackling one of the hardest lessons in trading, how to day trade without blowing up your account. We'll break down the traps that wipe traders out, share real stories that hit close to home, and give you practical steps to keep your account alive long enough to actually grow. Sit back, relax, hit subscribe so you don't miss what's coming next, and let's get into it. Let's start with the illusion. When people imagine day trading, they picture action. Constant trades, fast money, every flick of the chart looks like opportunity, the adrenaline is part of the appeal. But here's the first trap. Movement is not opportunity. New traders don't see this. They think more trades equals more chances to win. So they fire off order after order, chasing every candle, every headline, every pop in volume, and maybe one or two of those trades work. But the rest, they chip away at the account like a leak in the hull of a ship. Small losses, spreads, slippage, they all add up. Take a fictional example. Ethan. He opens a $2,000 account and decides he's going to scalp the market. On his first day, he takes 18 trades. A handful are winners. But because he's jumping in late, getting chopped in and out and paying fees on every move, he ends the day down $300. Not catastrophic, but painful. The next day, the same thing happens. This time, he doubles his size, convinced he just needs one good trade to get it back. But the market doesn't care. By the end of the week, Ethan's account is cut nearly in half. That's the illusion in action, mistaking activity for progress. And it doesn't just happen to retail traders. Entire firms have gone down chasing the same illusion. Remember Amaranth Advisors? Back in 2006, they were one of the largest hedge funds in the world. Then their head energy trader, Brian Hunter, made a series of huge leveraged bets on natural gas. At first, it worked. The illusion of fast, easy money looked real. But when the market turned, those oversized positions bled billions. Within weeks, the entire fund collapsed. What Ethan does on a $2,000 account, Amaranth did with $9 billion. The scale changes, the psychology doesn't. Another part of the illusion is speed. We've been conditioned to think that faster is better. Grow your money quickly, flip your account, double it in a month. That's the kind of story that gets clicks and views. And yes, sometimes it even happens. A trader hits a hot streak and turns a small account into something impressive. But here's what you don't see. Most of those streaks end in disaster. Look at Archegos Capital, run by Bill Huang. For a while, he looked like a genius. Using insane leverage, he turned a relatively small fund into tens of billions on paper. Banks were fighting to give him capital. His positions looked unstoppable. Then, in 2021, it all unraveled in a matter of days. Archegos lost $20 billion, and several major banks were left holding the bag. From the outside, it looked like brilliance. On the inside, it was nothing but oversized bets that worked until they didn't. That's the seduction of quick money. It blinds you to risk. It tricks you into thinking you found the shortcut. And when the market turns, because it always does, the illusion shatters. Here's why this matters. Retail traders fall for the exact same pattern every day. They see someone post about turning $1,000 into $50,000 in a month. They get jealous, inspired, whatever you want to call it, and they start believing they can replicate it. They double their size. They stop respecting stops. They chase tickers they don't even understand because they're moving. and maybe they get lucky for a bit. But eventually, the trap closes. Take another fictional trader, Sophie. She starts with discipline, small size, clear plan, but one day she gets smoked on a bad trade. Maybe she hesitated on the stop. Maybe news hit unexpectedly. She's down $500, which is half her account. Instead of walking away, she gets angry. She wants it back. So she jumps into the next ticker she sees moving, no setup, no plan, it fails. She doubles down again. Within hours, she's blown out. That's revenge trading, the most destructive illusion of all, because it feels like control, but really, it's just your emotions hijacking your account. And here's the brutal part. Every trader who's been around long enough has felt that urge. The difference is, the ones who survive are the ones who don't give in. So why do traders keep falling for the same illusions? One word, dopamine. Every time you take a trade, your brain fires off a hit of it. It feels good. And if that trade happens to be a win, even better. That's why you'll see traders taking setups they know aren't part of their plan because their brain craves the action more than it craves the discipline. The problem is, dopamine doesn't compound. Wins don't stack into discipline. They stack into ego. And ego is what gets traders destroyed. That's why early wins are often more dangerous than early losses. Losses at least teach caution. Wins inflate your confidence, tricking you into thinking you've got it figured out when you don't. It's the same cycle we saw with Niederhofer, Amaranth, Archegos, just on different scales. Quick wins created an illusion of brilliance. The market eventually reminded them otherwise, and that's the illusion of day trading in a nutshell. Believing movement equals opportunity. Believing speed equals success. Believing wins equals skill. It's all a lie, and if you fall for it, your account won't survive. The question is, how do you avoid it? That's where we go next. When traders blow up, it's rarely because they didn't know enough about charts. Most of the time, it comes down to behavior, the habits that sneak in when you're under pressure. And if you don't recognize them, they'll drain your account until nothing's left. The first one is overtrading. Every beginner thinks more trades means more opportunity. They come into the market with this idea that they need to be in the action all day. But that's not how professionals operate. The best traders are often the most patient. They wait for their setup, they wait for their conditions, and they let the rest pass. Ethan, the trader I mentioned earlier, learned this the hard way. After a rough week of chopping around, he decided the solution was to take even more trades. He thought, if I just give myself more chances, one of them has to work. What actually happened is that he dug the hole deeper. By the end of the month, he realized that out of 200 trades, only a handful came from his actual strategy. The rest were impulses, noise trades he couldn't even explain in his journal. That's what overtrading does. It convinces you that activity is progress when really it's just wasted energy. And worse, it makes your edge, if you even had one, completely disappear in the noise. Then there's revenge trading. Everyone who's been in the market knows that sting when you take a big loss. It doesn't just hurt financially. It feels personal. It feels like the market embarrassed you, called you out. And in that state, your instinct is to fight back. You want to make the money back right away. That's exactly what happened to Sophie. One bad trade, a hesitation on the stop, and suddenly half her account was gone. Instead of walking away, she felt this need to prove herself. She took the very next setup she saw. No plan, no risk management, just desperation. And when that one went red, she doubled down. By the end of the session, her account wasn't just hurt, it was destroyed. That spiral happens faster than you think. It's not the initial loss that kills most traders. It's the chain reaction that comes after, when you stop trading your system and start trading your emotions. And that brings us to the third account killer, oversizing. Nothing makes a trader feel invincible like a hot streak. You win 3 or 4 trades in a row, and suddenly, you're convinced you're onto something bigger. So, you size up. Not a little bit, but dramatically. You go from risking $50 a trade to $300 overnight, telling yourself it's just accelerating growth. Marcus fell into this exact trap. He had a decent stretch of wins, enough to boost his $3,000 account to $5,000 in a few weeks. It felt like proof. So the next trade, he went all in with oversized size, thinking he had the magic touch. But when that trade turned against him, the loss was so big, he froze. He couldn't cut it. By the time he did, most of the account was gone. The painful truth is that oversizing doesn't just amplify your financial risk, it rewires your psychology. Suddenly, a tiny move against you that should feel manageable now feels catastrophic. Your palms sweat, your heart races, you second guess every click. The size changes the way your brain processes the trade, and that leads to mistakes you wouldn't normally make. This isn't just a retail trader issue. Some of the biggest blowups in history came from oversizing. Look at Amaranth Advisors again. Billions gone because one trader bet too big. Or Archegos, leverage piled on top of leverage until the whole thing collapsed in days. If billion-dollar funds can fall to oversizing, what chance does a small account have if it doesn't respect size? And finally, there's the silent killer, ignoring stops. Every trader swears they'll respect their stop until the moment it actually matters. The candle ticks closer, the red number flashes on the screen, and suddenly the plan goes out the window. You think, maybe it'll bounce. Maybe just a little longer. And sometimes, by sheer luck, it does. That's the most dangerous outcome of all, because it teaches you the wrong lesson. Victor Niederhofer was once one of the most respected traders in the world. He built a fortune, wrote books, managed money for top clients. But his downfall came from the same mistake retail traders make every day. He refused to cut losses quickly. He held on, believing the market would turn. In 1997, during the Asian financial crisis, those losses spiraled. His entire fund collapsed. Decades of reputation gone in an instant. That's the danger of ignoring stops. It's not just the money. It's the precedent you set for yourself. The first time you break your rule, it's easier to do it the second time. And by the third, it's just how you trade. Eventually, the market hands you a move so large it wipes you out completely. These mistakes, overtrading, revenge trading, oversizing, ignoring stops, are the four horsemen of account destruction. They're not glamorous. They don't come from complicated strategies. They come from human psychology under pressure. And if you don't build guardrails against them, you will fall into them. The market doesn't need to beat you to destroy you. You'll do it yourself. What's wild is that these same mistakes don't just happen to beginners. Niederhofer ignored stops. Amaranth oversized. Archegos doubled down. Professionals with billions, access to the best data and research in the world, still fell for the same traps retail traders do. The only difference is when they blow up, it makes headlines. When you blow up, nobody notices except your bank account. So the question becomes, how do you avoid repeating the same cycle? How do you build habits that protect you from yourself so you can actually survive long enough to grow? The answer isn't about finding a perfect strategy or a secret indicator. It's about rewiring how you think about trading in the first place. It starts with probabilities. It starts with accepting that no single trade matters. It starts with trading more like a robot than a gambler. And once you make that shift, the whole game changes. The traders who survive day trading aren't always the smartest. They're not even always the most skilled. The ones who make it are the ones who learn how to survive their own psychology. Because more often than not, it isn't the market that destroys accounts. It's the trader sitting at the keyboard. Here's where most people get blindsided. It's not the losses that are the biggest danger in the beginning. It's the wins. A new trader takes a few trades, lucks into a streak of winners, and suddenly they feel like they've cracked the code. Their brain floods with dopamine. It feels validating, intoxicating. They start to believe they're special, that maybe they're one of the few destined to beat the market right out of the gate. That's exactly how Marcus went from cautious to reckless. He built his account steadily for a few weeks, taking small wins. But after 5 winners in a row, he convinced himself he'd leveled up. He told himself the market was easy, that he just needed to size up and push harder. Within days, his account was cut in half. The market hadn't changed. His psychology had. The illusion of being unstoppable flipped into a spiral of oversized losses. That's why early wins can be so dangerous. Losses sting, sure, but they at least make you cautious. Wins inflate your ego and convince you that the rules don't apply. And once ego takes the wheel, your account is on borrowed time. History is littered with examples of traders undone not by ignorance, but by overconfidence. Niederhofer, who I mentioned earlier, wasn't a fool. He was brilliant. But brilliance paired with ego is lethal. His refusal to accept that he could be wrong magnified his losses until there was no coming back. Even George Soros, one of the most successful traders of all time, built his legacy on humility. He famously said that what made him rich wasn't that he was right, but that he knew how to cut his losses when he was wrong. That kind of mindset, the acceptance of uncertainty, is what kept him alive. Day traders often miss this lesson because they're so focused on the outcome of each trade. Win or lose, profit or loss. They measure success one click at a time. But survival isn't about the next trade. It's about the next thousand. Imagine a coin flip game. If you flip a coin 100 times and bet small, the results will average out. But if you go all in on a single flip, even if the odds are fair, one wrong outcome ends you. That's exactly how most traders operate. They treat each trade like it's life or death, when really each trade should be one of many in a long series. Sophie's revenge trading spiral proves this. Her first loss wasn't catastrophic. It hurt, but it wasn't account ending. The damage came from treating that single trade as if it was everything. She needed to win it back immediately. She couldn't accept that one trade didn't matter. And because she couldn't, she destroyed her entire account. That's why the shift to probabilities is so critical. The traders who last don't ask, will this trade win? They ask, if I take this trade 100 times, does it make money overall? And can I survive the losing streaks along the way? It sounds robotic, almost cold, but that's the point. Robots don't revenge trade. Robots don't size up just because they're feeling it. Robots don't get tilted after a loss. They just execute their system, trade after trade, knowing that the edge plays out over time. The irony is that most traders say they want freedom. They want the thrill of calling their own shots, but the only way to get that freedom is to strip away the thrill in the first place. Discipline over dopamine, probability over ego, and that's where the grind comes in. The grind is the phase every trader has to endure, and almost none want to. It's when you're logging trades, journaling setups, reviewing charts night after night, and your account barely moves. It feels pointless. It feels like spinning your wheels, and that's exactly why so many people quit during this phase. But the grind is where the foundations are built. The $20 win today feels insignificant. The $50 loss feels heavier than it should. But what you're really building is the muscle memory of sticking to your system when the stakes are small. If you can't trade a $2,000 account with discipline, you won't magically develop it when you're trading $200,000. The numbers change. The psychology doesn't. Lena, one of our fictional traders, understood this better than most. She wasn't flashy. She didn't chase every setup. She focused on two simple strategies, journaled every trade, and tracked not just her wins and losses, but her emotions. After a losing streak, she wrote down how tempted she felt to tilt. After a hot streak, she logged how cocky she felt about sizing up. Over time, that journal became her mirror. It showed her that her biggest enemy wasn't the market, it was herself. That's why journaling is such a powerful, underrated tool. Without it, you're flying blind. Your memory is biased. You'll remember the wins that made you feel smart and conveniently forget the losses that embarrassed you. You'll convince yourself your strategy is profitable when the data says otherwise. Only by writing it down and reviewing it do you see the truth. It's boring. It feels like homework. But it's exactly what separates traders who keep repeating the same mistakes for years from the ones who actually improve. Think of it like sports. The highlight plays happen in the game, but the real improvement happens in practice. The drills, the film review, the hours nobody sees. That's where athletes build the habits that win championships. For traders, the journal is practice. The review is practice. It doesn't give you dopamine, but it gives you discipline. And discipline is the only antidote to the psychological traps that blow traders up. The truth is, most people aren't ready to treat trading this way. They want excitement. They want the rush. They want to feel like geniuses after a big win. And the market will let them. For a little while. But sooner or later, the bill comes due. And the traders who haven't trained their psychology, who haven't built guardrails against their own impulses, won't survive it. That's why survival isn't passive. It's active. It's a skill you train, just like any other. You train yourself to cut losses without hesitation. You train yourself to size up slowly instead of in leaps. You train yourself to think in series, not single trades. You train yourself to log the boring details, even when nobody's watching. That training doesn't feel fast. It feels slow, tedious, frustrating, but in the long run, it's the only thing that actually accelerates growth. Because the paradox of trading is this: the fastest way to grow is to stop chasing fast growth. The more you focus on survival, the more compounding has a chance to do its job. The more you protect yourself from the ego traps, the more room you give your edge to play out. And when you finally hit the point where your account size is big enough that a single day's gains cover a month of bills, you'll realize it wasn't the big wins that got you there. It was the boring survival work that kept you in the game long enough to see it happen. Most traders want to skip the grind. They want to get straight to the highlight reel, the big wins, the screenshots, the lifestyle. But trading doesn't work that way. The grind isn't optional. It's the filter that separates those who make it from those who disappear. The grind is the long stretch of time where it feels like you're working hard for nothing. You're logging trades, reviewing charts, sticking to your rules, and at the end of the week, your account is basically flat. Maybe you made 50 bucks. Maybe you lost 50. It doesn't feel like progress. It feels like stagnation. That's why most people give up. They tell themselves it isn't worth it. They look for shortcuts. They start chasing new indicators, new strategies, anything that promises faster results. And that's exactly when the blowups happen. But here's the reality. The grind is where the foundations are built. Every boring habit you practice in this phase is the exact habit that will keep you alive when you're trading bigger size later. Logging trades when it feels pointless, that's what helps you stay objective when you're risking thousands. Journaling your emotions when nobody cares, that's what teaches you to recognize when you're about to tilt. Sticking to your system even when it feels like it isn't working, that's what proves whether you actually have an edge or not. Think about it like training for a marathon. The race itself is exciting. Crossing the finish line is rewarding. But the months of early mornings, the long runs in the rain, the stretches where you feel like you're not improving at all, that's where the endurance is built. Without that grind, there's no finish line. Lena, the trader I mentioned earlier, treated the grind with respect. She didn't chase shortcuts. She didn't get seduced by hot streaks. She journaled every trade, reviewed her setups, and accepted that for a while, her account wasn't going to change much. But what did change was her consistency, her discipline, her ability to sit on her hands when the setup wasn't there. And eventually, when her size grew, those habits paid off in ways that seemed exponential. Contrast that with Marcus. He hated the grind. He wanted excitement. So after a few months of steady but small progress, he decided he was ready for the next level. He doubled his size, then doubled it again. And for a short time, it worked. His account ballooned. But because he never built the discipline in the grind phase, the first real drawdown shattered him. He panicked, broke every rule, and within weeks, he was back at zero. That's the difference. The grind isn't punishment, it's preparation. It's the market's way of asking, are you serious enough to survive when it feels pointless? And most people answer no. This is also why journaling is so powerful. On the surface, it looks boring. You write down the trade, the setup, the entry, the exit, but the real gold comes when you log your emotions. Did you hesitate on the entry? Did you size up recklessly because you felt invincible? Did you cut the winner too soon out of fear? Those notes reveal your patterns in a way charts never will. Without journaling, your memory lies to you. You'll remember the wins that made you feel smart and conveniently forget the losses that exposed your flaws. You'll convince yourself you're following your system when you're actually not. Only by writing it down do you see the truth, and the truth can sting. It's humbling to realize that half your trades weren't even part of your plan, or that every time you win, your next trade is oversized and reckless, or that you keep hesitating on stops, and it's costing you more than your actual strategy. But that sting is what creates awareness. And awareness is what creates change. There's a reason professional traders and funds treat journaling and review as non-negotiable. It's not busy work, it's feedback. It's the only way to know whether your edge is real or just an illusion. The irony is that most people think journaling slows them down. They want to skip it so they can trade more. But skipping the grind doesn't make you faster. It makes you repeat the same mistakes for years. The traders who log, review, and adjust accelerate their learning curve. The ones who avoid it stay stuck, going in circles until they give up. The grind also teaches you to respect boredom. That might sound strange, but boredom is one of the most powerful signals in trading. If you're bored, it usually means you're not forcing trades. You're waiting. You're letting the market come to you. Professionals embrace boredom because it keeps them out of trouble. Amateurs run from it because they crave action. Ethan, our overtrader, hated boredom. He thought if he wasn't trading, he wasn't progressing, so he clicked away, jumping into every ticker that moved. Over time, he realized his biggest drawdowns didn't come from bad setups. They came from boredom trades, the ones he took just to feel like he was doing something. Boredom is a sign you're doing it right. Overtrading is a sign you're doing it wrong. That's a hard lesson to accept, but it's the kind of mindset shift that saves accounts. Even at the highest levels, the grind is unavoidable. Linda Rashka, one of the most respected day traders of her generation, didn't build her career on excitement. She built it on discipline, on repeatable setups, on showing up day after day, and executing the same boring process. Her edge wasn't flashy. It was consistency, and consistency only comes from embracing the grind. Here's the paradox. The grind feels slow, but it's actually the fastest path forward. Because while everyone else is blowing up accounts chasing shortcuts, you're quietly compounding habits, and those habits scale. The trader who can stick to a plan with a $2,000 account is the one who can scale it to $200,000 without imploding. That's the hidden math of trading. The dollars don't compound on their own. The habits do, and once the habits are solid, the dollars follow. So the next time you're in the grind, staring at a journal, logging another tiny trade, feeling like nothing is happening, remember this: you're not building for today. You're building for the future version of yourself who can handle size, pressure, and volatility without flinching. The grind is where that version of you is created. And once you understand that, boredom stops feeling like wasted time. It starts feeling like proof that you're on the right path. Because the truth is, the grind isn't a detour. It's the only road forward. So if the grind is where the foundation gets built, what does it actually look like in practice? How do you day trade in a way that doesn't just keep you alive, but puts you on a path to long-term growth? It starts with risk. Every trader has to decide, before they even click the button, how much they're willing to lose per trade. Not on a good day, not when they're feeling confident. Always. That number has to be small enough that a single loss doesn't shake your emotions, but consistent enough that your data is real. For some, it's 1% of the account. For others, it's even less. The exact number doesn't matter as much as sticking to it without exception. Because here's the truth. The only loss that kills you is the one you don't plan for. Every other loss is just business expense. Next is the daily stop. Professionals don't sit around bleeding out their accounts all day. They know that when they're tilted, they're dangerous. So they set a max daily loss, maybe 2 or 3 trades, maybe a set dollar amount, and once they hit it, they walk. That rule saves accounts. It stops a bad morning from becoming a blown-up account by the afternoon. Sophie never had that rule. After her first big loss, she kept going. That's what destroyed her. If she had shut it down after the initial hit, she would have lived to fight another day. Instead, her spiral wiped her out completely. Then comes scaling. This is where so many traders sabotage themselves. They start small, they build a rhythm, and then one day, they decide they're ready for the big leagues. They double or triple their size overnight. But trading doesn't work like a video game. You don't unlock bigger size just because you've won a few rounds. The brain doesn't adjust that quickly. A $20 loss might feel fine, a $200 loss might feel catastrophic, and once your brain goes into fight or flight mode, all your rules fly out the window. The way to scale is like climbing stairs, not riding an elevator. Slowly, one step at a time. You increase size so gradually that your emotions barely notice the difference. You let your psychology adapt at each level before moving up. It's slower in the short term, but in the long run, it's the only way to scale without blowing up. That's how Lena grew her account. She proved her edge small, then inched her risk higher over time. By the time she was risking real size, it didn't feel any different to her than the small trades did, because her psychology had been trained at each step. Compare that to Marcus, who went all in after a hot streak. His growth looked fast for a few weeks, but it was an illusion. The first drawdown took him out completely. That's the cost of skipping the staircase. Another piece of the blueprint is journaling. Not just writing down your trades, but your state of mind. Were you bored? Were you chasing? Were you trading out of fear of missing out? That's where the real edge lies. Because in day trading, your biggest opponent isn't the market. It's you. Ed Seykota once said, "Everyone gets what they want from the market." What he meant was, if you want excitement, you'll trade in ways that give you excitement, even if it costs you money. If you want to avoid pain, you'll hold losers too long because selling them feels worse than watching them bleed. The market has a way of exposing what you really value. The only way to break that cycle is to track your own behavior honestly, then confront it. That's why the best traders build systems to protect themselves from themselves. Not because they're weak, but because they're self-aware. They know that discipline can't just live in their head. It has to be written down, reinforced, and reviewed. And that brings us to the bigger picture. Most people treat day trading like a game. They chase high scores, every win is a dopamine rush, every loss is a rage quit. They measure success one trade at a time, and they act like the goal is to beat the market in a single session. But the ones who survive treat it like a business. A business isn't about excitement, it's about consistency. A business isn't about swinging for the fences, it's about protecting inventory, keeping costs under control, and surviving long enough to grow. Your account is your inventory. Blow it up, and you're out of business. Protect it, and you can keep compounding. George Soros didn't build a fortune by treating trades like ego contests. He treated them like hypotheses, experiments to be tested. When they worked, he pressed them. When they didn't, he cut them without hesitation. That flexibility is why he survived for decades while others blew up. Now zoom back to retail trading. Ethan, our overtrader, played the game. He treated every flick of the chart like a chance to prove himself. He wanted action more than he wanted profits. And in the end, that desire cost him everything. Lena treated it like a business. She journaled, managed risk, scaled slowly, and accepted boredom. Her growth looked boring at first, but because she survived, compounding took over. And in trading, compounding is the closest thing to magic. That's the paradox. The fastest way to grow is to stop thinking about speed. Focus on survival, and growth takes care of itself. Focus on excitement, and you won't survive long enough to grow. Think of it like running a coffee shop. In the first year, you're not pulling in six-figure profits. You're figuring out costs, refining systems, keeping the doors open. It's slow, sometimes frustrating. But if you survive, you build a foundation. The shop grows, the profits scale. The people who treated it like a hobby, they're out of business before their first anniversary. Day trading is no different. If you treat it like a game, it'll give you entertainment until you run out of chips. If you treat it like a business, it'll give you freedom, but only after you've proven you can run it responsibly. So here's the bottom line. Day trading is seductive because it promises fast money, but that promise is an illusion. The reality is harsh. Overtrading, revenge trading, oversizing, ignoring stops. These traps have destroyed accounts from beginners all the way up to billion-dollar funds. The traders who survive aren't the ones who found a secret indicator or hacked the system. They're the ones who respected the grind, treated trading like a business, and protected their capital like it was their lifeline. If you can make that shift, if you can think in probabilities instead of certainties, if you can embrace boredom instead of chasing dopamine, if you can see your account as inventory instead of a lottery ticket, then you give yourself a real chance. Because the truth is, most people who try day trading never make it. They blow up, they give up, and they walk away convinced it's impossible. But it's not impossible. It's just unforgiving. The market doesn't care about your ego. It doesn't reward shortcuts. It only rewards survival, discipline, and patience. So the next time you sit down at your desk, ask yourself, are you here to play a game or are you here to run a business? If it's a game, enjoy it while it lasts, because it won't last long. But if it's a business, then protect your account, respect your rules, and let compounding do its work. One day, if you stick with it, you'll look back at the grind, the boring journaling, the slow scaling, and realize none of it was wasted. It was the foundation for the kind of freedom most traders dream about, but never get to see. And that's how you day trade without blowing up your account.